All right, guys, the next set of ratios, we have the profitability over here. Profitability, as you can tell by its name, it shows the management's responsibilities and duties of generating earnings revenue. So how much profit we can retain from the generated revenues, that's what we're going to assess in this class of ratios. Excuse me, sorry. Just put our label here. Okay, there are several profitability ratios. We're going to evaluate different types of profitability, showing firms' ability to generate earnings and revenues. Okay, we're going to use liabilities and inventory. We're going to utilize the stock prices and all that. And bottom line, we're going to take a look at different profitability ratios to come up with a profit performance analysis for the hospitality businesses. Guys, the first and a very important ratio is the profit margin ratio. Profit margin ratio, let me just pull it up right here. Profit margin ratio, it shows the overall operating performance of a firm in terms of the profits, of course. How much sales are generated by the company, and of course, how much portion of them is converted to the profits. Therefore, it is called a profit margin, and of course we are going to analyze it and we are going to assess it by running the example right now. But again, the first one is the profit margin PM ratio. PM ratio is equal to, we will see in a second right here, guys. Okay, the question becomes, what is the profit margin ratio of XLS Hotel if its net income and total revenue are $267,000 and this amount respectively? Guys, so I apologize for the gap over here. I'm not sure why there's a gap, but I apologize for that. So profit margin is equal to NI, which represents net income, over TR, total revenue. We can tell how much net income we have over total revenue. It is 14.13%. We have the components over here when we do division. So simply, for every dollar of total revenues, we keep 14.13% of revenues. You want this ratio as high as possible. 14.13%, not so much. Only 14.13 cents. It is not so much. Therefore, you want this ratio as high as possible. Okay. Return on assets, ROA, is another ratio class, another profitability ratio class we have. And in this return on assets, we can talk about a whole bunch of different stuff. Guys, return on assets simply shows how much return you generate, how much return you realize using your assets for the investments, for expansion projects, or any other capital projects. In other words, it shows the percentage of profit that the company earns using the assets. That becomes the return on the assets. Okay, it is a key profitability ratio. It measures the amount of profit made by the company per dollar using the assets. It also displays the firm's ability to generate profits before leverage rather than using leverage. Leverage means, right here, leverage means the debt, guys. Okay, it's a measure for debt. Before using debt, before having additional debt in operational system of the companies, this ratio shows how much return we can generate using our inner resources, which are the assets. Okay, and of course, we're gonna find the percentage terms, and of course, just like the PM ratio, we need this ratio as high as possible. Take a look at the Hikanda Resort Hotel. Let me read the question first, and then we will deal with the solutions. Hikanda Resort Hotel experienced $335,000 worth of net income in 2010. Total asset value was this amount right here, and then this figure jumped to this in 2011. So what is the return on assets for Hikanda? Guys, we have two different values in terms of asset values, meaning we have to take the average of the total assets right here. Okay, therefore the main equation becomes NI, net income. By the way, net income is a great measure for profitability. NI, net income, is over average total assets. You can put it over here, average total assets, average TA is the equation. How much net income we have using our average total assets? That's what we're trying to measure. That sets the return portion. Using our assets, guys. Okay, so let me just clean the screen right here real quick, and then I will show you the equation, which you're already familiar with. This is my net income over here. This is how I take the average, guys. Okay, so 30.75%, meaning there was 30 cents and 30.75 cents return for $1 of average total assets invested in 2011. Again, it is a great number because it's positive, it's high, it's not like 0.006 or something like that, but you want this ratio as possible because a very, very low ROA result in inadequate profits or excessive assets that you're not using. A very high ROA may suggest older assets require replacement. For example, you're using too much non-updated assets like property management system, such as bed frames, simple bed frames, or such as the pool, such as the meeting space and all that. That's why there are great managerial implications based on this. So bottom line, you don't want ROA skyrocketing, but you don't want deep down grounded ROA as well. A balanced measure is very important for enough generation revenues. So ROE is just like ROA, slightly different, and the only difference is this one is equity, return on equity, amount of net income returned as a percentage from the stockholders' equity, owner's equity. So how much net income we are creating using the equity. Okay, guys? So take a look at this example right here, which is rated hospitality. Return on investment measured return on investment by shareholders. Of course, we want this ratio as high as possible because if you're talking on profitability, you don't want any lower profitability ratios. Excuse me. A rated hospitality enterprise observed the financial data for 2011 and 2012 respectively right here. Let me just change my marker. Respectively right here. Guys, we have balance sheet items as total assets, total owner's equity, and ROA. Okay, we have 2011, 2012 right here. We have the values, we just don't have the value over here, which is fine. Based on the financial data table above, find the ROE ratio for the Raiders Hospitality. Guys, ROE, take a look at the equation right here. There's a reason that we have a whole bunch of different numbers because ROA is equal to ROA multiplied by average total assets over average total owner's equity. Okay? So we need ROA, we need to average out total assets, we need to average out total owner's equity. That's why if you go back up and take a look at this table right here, that is why we have a whole bunch of different numbers that we are going to utilize to come up with the ROE. Okay, so take a look at my solution, guys. It's not a big deal. All we have to do a little bit more equation. So 10.80% ROA is given on the table. Look, 10.80% ROA for 2012 for Raider Hospitality is given right here. Okay. 10.80% over over average total assets over multiplied by average total assets over average total owner's equity. It gives us 45.34%, meaning for every dollar of owner's equity there is 45.34 cents earned or returned to the company. So owner's equity is other people's money. Investors, for example, we are using their money, investing in some assets, acquiring additional fixed assets, or having some capital expansion projects, and we are returning 45.34%, which is a great number of percentage. The lower owner's equity relative to total assets, the greater ROE. So lower owner's equity, that means lower owner's equity relative to total assets. Okay, this is the greater financial leverage, the greater the ROA, but sometimes it might backfire as well because of the financial risk. Therefore, balancing it out, you don't want too much. Balancing it out is important. That's why they need to be careful about debt usage, additional debt, adding its operations because of the ROE and lower ROE, lower retained earnings issues. So debt acquisition, by the way, again, we will talk about this more. in financial management course, but debt acquisition is only favorable if the required return on the investment or any other growth opportunities is higher than the bank rate that you have from the investment, guys. Therefore, of course, there are real numbers in the industry for every single company, but balancing it out is always a good idea for ROE, ROA, activity ratios, solvency ratios, and liquidity ratios. Excessive of everything is might backfire, just like this ROE issues over here. Earnings per share, let me just put it over here, EPS in short, EPS. Earning per share is not, but it is so typical, it is very powerful and it's very common, but it is not something you haven't been talking so far, because EPS represents, I will tell you in a second, it represents net income earned for each share of outstanding common stock. We are dealing with common stock right now. When we say common stock, there are two types of common stock. Well, stock, sorry. When we're dealing with the stock, there are two types of stocks, common stock and the preferred stock, okay? We are talking about how much we can earn per share just holding other institutions' stock. It could be common stock, it could be preferred stock, okay? We are measuring this, therefore we are trying to come up with the profitability analysis using the market values of those stock prices. Okay, so EPS changes based on selling and trading activities of stock by institutions or investors. Therefore, it becomes important because hospitality businesses, especially publicly traded companies, holds common stock of different institutions as well for investment purposes. Again, you will learn more about this in the financial management course, so I'm not touching base with it too much. Okay, EPS is determined by average common shares outstanding, okay, but there are two things. Again, when I say EPS, let me just put over here little arrows right here. We have CS, common stock, we have PS, which is the preferred stock. So they have different equations. I'm going to show you in a second. So take a look at this example as Bloomberg Hospitality Incorporated. So what we have a table, okay? We have a table from here. We have the financial data, net income, preferred dividends value, common shares outstanding. I'm going to talk about dividends in a second. We have 2010, 2011, okay? So our objective is to find, let me just clear this. Our objective is to find EPS for common stock, EPS with common stock, whatever you want to pick, and EPS for preferred stock for Bloomberg in 2011. So we're going to run two different types of EPS analysis using two different types of equations, okay? So guys, let me just go back up and then talk about dividends so it will be a little bit clearer. Guys, dividends are the extra chunk of money paid to the stock investors. Common stock, preferred stock, doesn't matter, okay? So preferred stock dividends are fixed. They are paid on a regular basis. Common stock dividends are not fixed, and it's under company's discretion to pay common stock dividends or not, okay? Therefore, dividends are the extra chunk of money to reward the investors by holding the stock of institutions, okay? That's exactly what it is. Keep that in mind. But again, you will learn this a lot. You will talk about this a lot in financial management courses. Guys, we're going to find EPS with common stock first, okay? EPS with common stock, let me just do it right here. Let me just clean this, and then I would like to put two equations over here so you can see everything in one screen. Okay, EPS with common stock, EPS CS, is equal to net income over average common shares outstanding. Net income over average common shares outstanding, CSO, okay? Again, this is how we take the average. So when we go back up and take a look at the table right here, guys, okay, we have common shares outstanding. We are dealing with 2011, by the way, okay, but we need 2010 because we're going to take the average. Average common shares outstanding, we're going to take those two guys, find the average, okay, and we're going to take the net income from 2011 to find out what it is. So our ultimate source for this Bloomberg Hospitality example is the table given over here, is the table given for the values in 2011. All we have to do, guys, we pick our numbers. This is the average of EPS outstanding. This is the NI, 2.39. It becomes $2.39 per share, meaning an investor earns 2.39 per share basis on the common stock investment in Bloomberg Hospitality. If Bloomberg Hospitality invests a capital amount of money, lump sum, to buys another company's shares, it earns 2.39 cents per share. Great amount of money, okay? Therefore, you would like to have high EPS ratios for both, common stock and the preferred stock, okay? So these are over here for mostly for financial management, but I'm just going to go over a little quick. EPS is expected to increase as the enterprise reinvests its earnings. Increasing EPS shows that the invested company has a great market value and all that. Therefore, it is bringing a great return on the stock investment as a hospitality company. Same goes for the preferred stock as well. Preferred stock, common stock, and preferred stock, they are different than each other. Preferred stock is a fixed income financial asset, and the common stock is not a fixed income. So that's the most important distinction between preferred stock and the common stock. So EPS with preferred stock, let me just put it over here, PS. The equation is net income minus the value of preferred dividends. Net income minus preferred dividends, PD, let's say, okay, over average CSO, average common shares outstanding, okay. So guys, you can see the difference over here. Preferred dividends, okay, but we don't have the preferred dividends over here. But we might have common stock dividends. I will get to this point. Just wait a little bit, okay? So I'm utilizing my table right now. This is NI minus PD portion. This is the average portion, 2.24. Same interpretation goes for the PS as well. I have 2.24 per share basis earnings from my investment. My investment is preferred stock investment as a hospitality company. Remember, guys, we talked about this. Hospitality companies also invest their extra money, the chunk of money, okay? And then they invest, they make money out of it. Their money work for them. Therefore, they can invest in common stock or preferred stock. So they can make more money, because nobody likes in real life none of the companies likes to have a chunk of money, a couple of $1 million, $10-15 million, whatever the money is, the value is, sitting around in the bank and doing nothing. They will like to work their money for themselves. Guys, this is very important. Please take a look at this. I'm going to put in my pink marker. So we mentioned that EPS with common stock, NI over average CSO, common shares outstanding, they don't have the PD over here, preferred dividends. Because preferred dividends has to be in this equation no matter what, okay? It's always like this. It never changes. But CS, EPS, CS equation can change. Why? Because preferred dividends are fixed dividends. They have to be paid to the investors all the time. But common stock dividends are under company's discretion. Therefore, it doesn't have to be paid to the investors frequently, like quarterly. These are the dividends are paid quarterly. If there are common stock dividends paid to the investors, the value of dividends will be added to the net income for the EPS calculations. So it will be plus common preferred, common dividends, CD over here. Only if the company pays the common stock dividends, the amount of common stock dividends will be added to the net income. Therefore, let me clean my screen over here. Therefore, my equation will look just like this. EPS with common stock is equal to net income plus common shares dividend value over average common shares outstanding. Again, if in the question there is common shares outstanding for the common stock, you have to add that on top of net income over here, just like in the equation, okay? Therefore, the previous equation will change, because in the previous equation, we didn't have common stock dividend payments. The common stock dividend payments, again, is under the company's discretion. It can be paid, cannot be paid to the investors. It's up to the companies. Okay, guys? So please keep that in mind. Well, I'm going to make a squeeze over here. Let me change my marker. PE ratio is another profitability ratio. PE ratio goes hand in hand with EPS ratio, okay? Price to earnings ratio, it is what it is. It is what stands for. It represents the investor's expectations for the stock. For example, a P for the industry in general, a PE ratio greater than 15%, $15 is considered too high. It's a little unrealistic, okay? So for the hospitality industries, the PE ratio is usually somewhere around $1 to $2, not too much, okay? Well, this is just an example, okay? This is just an example, so I use arbitrary numbers. Mall Hospitality Enterprise acquired market price per share $37 and $10. This is what the price of firm's stock currently trades. Imagine that. Imagining its EPS is $3.45. What is the PE ratio for Mall? Again, PE ratio goes hand in hand with EPS because it is market price MPS per share over EPS. EPS is this EPS right here is going to give us the PE ratio for Mall. It is $10.75. This number demonstrates the valuation of company's current trade per price. So the true value or the fair value per share of the Mall Hospitality Enterprises must be $10.75. Sometimes it deviates from this number, okay? It shows overvaluation or undervaluation. But again, financial management classes will pick up this issue more and more and in detail. Higher PEO suggests investors are expecting higher earnings growth in the future compared to companies with lower PE. You want this high or lower? Usually you want this high, okay? Not too much high, again, not too much low, because it sets the expectations. If the PE ratio is too high, you are a risky company, because higher the risk, higher the return. If you're returning so high values, that means you must be a risky company. Startups, growing companies, but again, I am not touching those issues too much because it is the topic of financial management, guys. But I want you to know that EPS and PE is also the profitability ratios that you will learn more in the future, okay? So guys, this was the profitability ratios. We have operating ratios. Let me scroll down. We have operating ratios. I'm going to go over this, and before that I'm going to talk about something else as well. But before everything else, let me just clean my screen so I can utilize this section for your convenience. Guys, by the way, don't forget to practice a lot, please, because without practice, these issues might not be understood fully. So I need you to practice, please, solve in-class exercise and the quiz questions and the set questions in the homework or any other class assignment. So please do the practice, okay? All right. So guys, operating ratios, okay? Let me talk about this real quick. I'm not going to talk about this, I'm going to talk about something else right now, and then I will get to that point. Operating ratios shows companies' operational activities. Operating ratios can be modified based on a specific industry classes, specific sectors. Since of course we are talking about hospitality industry, the ratios you're going to see right here is modified to hospitality dynamics. Hospitality business dynamics and operational dynamics, operational systems, okay? Operating ratios assist management in analyzing the operations of a firm. Well, we don't care about how many ad clicks that we have, but Google cares about how many ad clicks they have, okay? Google doesn't care about RevPAR, revenue per available room, but Marriott cares about revenue per available room. Therefore, as I said before, operating ratios are modifiable. In this part of lecture, which is the last part of this lecture, you will see a whole bunch of different ratios specifically, exclusively modified for the hospitality industries, okay? Each ratio has different inputs measuring different segments of the operations, but it gives the clear picture of operational performance, expense revenues, control purposes, inventories, turnovers, employees and labor. It becomes very important for a single hospitality operation, guys. Okay, take a look. What I said is over here, by the way. Okay. Revenue per available room, rev PAR, is one of the most important operating ratio for the hospitality industries because it literally shows revenue generated for the hospitality operations, okay? Sorry, revenue generated for available rooms, not number of rooms sold, available rooms. There's a heavy reliance on occupancy percentage and ADR in this ratio, and of course you want this ratio as high as possible. Okay, the amount of revenue on per room basis generated is the main focus of this ratio. Take a look at this. Take a look at this example. But before the example, I think I'd like to mention a couple of stuff. RevPAR is calculated in many different ways. I'm going to show you the two common ways of calculating RevPAR based on a Martin Hotel. Take a look. Martin Hotel has 3,400 rooms available for its customer capacity. This hotel acquired 85% occupancy and an ADR of $90 in 2010. Based on the operational data for rooms department, what is the RevPAR in 2010? Guys, RevPAR can be calculated using two different equations. These are the main equations. One of them is rooms revenue over available rooms, or occupancy multiplied by ADR, depending on the information given to you in the question. But for this specific question, I write just like this in purpose so I can use both of the equations to come up with the same amount of RevPAR as you can see on the screen. So rooms revenue, I have 3,400 available rooms. I have 85 rooms revenue, sorry, 85% occupancy, multiplied by 90. This is number of rooms sold over here, number of rooms sold, multiplied by ADR, over available rooms, 3,400, it will give me $76.50. When I use the other equation right here, 85% occupancy multiplied by $90, it will also give me $76.50. So same, again, depending on what's given to you in the question, you can use those equations interchangeably, okay guys? And of course, as I said before, you want this high RevPAR numbers, high RevPAR ratios, because it is companies' benefit to create higher, generate higher revenues per room basis. Revenue per available customer, RevPAC, is another great indicator for hospitality industries because it shows overall revenue received from each hotel guests. Overall revenue generated from each hotel guest, of course. You want this ratio as high as possible as well. Take a look at this example, Rocken Industry, $750,000 in revenues from $8,000 guests. We are trying to find the RevPAC over here. This is the equation, meaning the equation is TR from hotel guests, from HG hotel guests, over total number of G guests, okay? So we have both of the components over here. We will do a simple division. $93.75 is generated from every single customer in the hotel. And of course, you want this ratio as high as possible. This is for on average, because if the customers create more revenues, you will have more profits at the end, cover your liabilities at a great level, and then you will be a solvent and liquid company, and that's exactly what you want as a hospitality decision maker. Gross profit, gross operating profit, or gross profit, same thing, per room, PP, lowercase and uppercase, per room right here. These are my abbreviations, by the way. You can just come up with yours, but usually they usually use the full name, okay? This ratio shows management's ability to produce gross profit from each room sold, and of course, you want this ratio as high as possible again, because it's an operating ratio. Gross operating profit per room is equal to gross operating profit over total number of rooms sold. Gross profit, let's say gross profit over total of rooms sold. I have both of the components. I will do the division. 18.88 gross profit is created per room, which is the exclusion of expenses, tax, and interest payments. That's important because it is the gross profit, not the profit itself. That's why it is the exclusion of operating expenses, taxes, and interest payments. 18.88 is a little bit low. You want this ratio is around $25 to $30 because you still have to deduct expenses per room, taxes per room, and interest payments per room as well. Therefore, higher figures are desirable for gross operating profit ratio. Well, these are mostly for cruise line establishments, hotel establishments, or any establishment provides accommodation. But now, average food service check, FSC, is mostly utilized by restaurant companies because it shows the dollar amount generated for each food cover on average for the period being measured. For the period being measured because some of the restaurants are closed on Mondays, let's say, or Sundays like Chick-fil-A. Okay, so that is why I throw the period being measured over here in my lecture notes. So you want this ratio higher, guys? Of course, because it shows on average how much revenue is generated per each guest on average. Fun Stop restaurants, okay? Fun Stop restaurants, 65,000 food plates. Could be steak, could be fish and chips, could be anything. And they acquired $480,000 of revenue. What is the average food service check? Very easy. Take a look. Total food revenue over total number of food plates. Total food revenue, TFR, over total food plates, TFP. It will give us $7.38. Each guest is giving you $7.38 for each plate on average. You want this ratio as high as possible. You want this 9, 11, 10, whatever. So that means you are selling more and they are willing to pay your product, F&B products, more and more. Okay. Average guest occupancy per room sold is another operating ratios. Average guest occupancy per room, PR. Okay. It shows management's ability to sell the property's available rooms on per room basis. How much occupancy you are generating per room sold based on your capacity. He then welcomed 23,456 guests in 2010. Also, there were this amount of rooms occupied in total. What is the average guest occupancy per room sold? Guys, the equation is, take a look at the equation right here. Total number of guests over total number of rooms occupied. Total number of guests, TG, total rooms occupied, TRO, okay? When I do the math, 1.12 guests, every room on average is occupied by 1.12 guests. Why? Because having more guests, meaning that you are selling rooms with 2 queen beds, there are a lot of people, there's a high potential for them to buy your amenities, your F&B products, and or any other products. Therefore, you need this ratio as high as possible. 1.12, actually 1.12, 1.15, 1.20 is the norm for the hospitality industries. Another ratio we have is the double occupancy or multiple occupancy ratio. It is related, you want this pretty high. It is related to, let's say, multiple MCOO percentage. Okay, multiple occupancy, let me just put that here. It shows how many rooms are occupied by 2 or more people rather than total number of guests. Okay, you want this sometimes because multiple occupancy gives you an idea for pricing. You remember chapter 4 for pricing. Multiple occupancy gives you an idea if your rooms are demanded by 2 or more guests or just single guests, or it gives you an idea about your customer profile as well. So there are another implications for measuring the multiple occupancy percentage too. Lion Hotel is the example had 3,100 guests in rooms where there were 2 or more people stayed in 2011. It could be standard room with 2 queen guests, or it could be suite room with more than 2 guests, 2, 3, 4, whatever that is. If the total number of guests was 19,500, what was the multiple occupancy for the Lion? rooms occupied by 2 or more people over total number of guests. Rooms occupied 2 or more. Let me just put it like this. I know it doesn't make sense, but total number of guests, TG again. So let me take a look at this. 15.90% of your rooms are occupied by 2 or more people. You want this ratio higher because I just said that use of facilities, use of amenities are needed by the hospitality companies as well. Therefore, you want this ratio as high as possible, okay? The last ratio we have, guys, I promise this is the last ratio. Seat turnover, well, I don't have the space over here. I'm just going to write it like here, okay? I'm just going to write on top. ST, seat turnover. It's a non-financial ratio used by restaurants mostly, measures occupancy for eating and drinking establishments, okay? It shows the usage of food and beverage establishments by your customers. How many times a seat in a restaurant is turned by the customers. So you want this ratio higher as possible. But some of the restaurants, they don't want higher as possible. I'll tell right now before I get to the example. McDonald's. Do you want seat turnover high or low? Of course, high. Very high-end ADVs, for example. Do you want seat turnover high or low? Of course, low. Why? Because ADV is a luxury restaurant. When the guests sit, they experience lengthy dining and enjoying the time, 2 or 3 hours sometimes, but of course the pricing is adjusted to that as well. McDonald's, $10, $15 for 2 or more people, maybe, I don't know, maybe less than that. So high seat turnover, they come, eat, leave in 10-15 minutes, ADVs 2-3 hours, 10-15 minutes versus 2-3 hours, that creates seat turnover differences. So even within the sector, within the restaurant industry, depending on size and the segment of your restaurant and the type of your restaurant, seat turnover ratios differ. Usually, high seat turnovers are desirable. Usually, I'm not saying all the time, usually, but again, there are some distinctions as well, and I just talked about this. ADVs and McDonald's example, always remember. Chimi's Bar and Restaurant experienced 61,000 food plates served to its guests over the year 2010. This restaurant opened 365 days in a year, and there are 125 seats available in the establishment. Based on the information given, find the seat turnover ratio. Seat turnover ratio, total number of food plates served, total number of FP food plates served, over total number of seats, multiplied by number of days open. Days open. Okay? 61,000 number of food plates served, 125 seats, 365 days open, 1.35 times. 34 times means that each seat was used or occupied 1.35 times during the entire year. Management would like to see the higher seat turnover for sports bar type of restaurants. Of course, higher seat turnover is needed. Okay? But a declining trend may indicate lowering of service or not much customer traffic is generated. Food quality and the location, and there are better restaurants in the competition, so on and so forth, might be the reasons as well. This is a little crowded. I'm sorry about this, guys, but this is the last ratio in this lecture, and this concludes our lecture video for chapter 6. As I'm clearing this, I'm going to wrap up real quick for the chapter. We have 5 different class of ratios, touching base with every single corner and edge in the operations, internal, external, to come up with a financial condition and financial health of the hospitality companies. Everything is interrelated, every single ratio interrelated. Some of them are expressed as percentages, some of them are expressed as the value, number value, but bottom line, interpretation becomes very important for each ratio because deriving the ratios are very, very straightforward and thorough. Therefore, interpretation becomes very important. A successful general manager utilizes every single ratio and come up with a decision by looking at every single ratio. And then for liquidity, solvency, operating, it doesn't matter. A successful manager or decision maker comes up with a great interpretation by looking at the potential lacking areas as well. So therefore, if you can think that way when you're studying this chapter using the lecture notes and or lecture video, it will be your benefit, guys. Okay, so this concludes my lecture video for chapter 6. Please check your course schedule, as I mentioned this at the beginning of our lecture. Please take a look at your upcoming deadlines. If you have any questions, please do not hesitate to contact me at all. And have a great day, week, evening, and I will see you guys in the next lecture video for chapter 7. Thank you.